From CRI Simple Numbers, this is Profitability Playbook, the Simple Numbers Podcast, a podcast for those who champion market growth and anchor the nation's economy, small businesses, and entrepreneurs.
All right, welcome to episode 4, Profitability Playbook, the Simple Numbers Podcast. Got Brandon Gray and the all-powerful Greg Crabtree here, and everyone who's listening, just if you're just tuning in for the first time or whatever, we'll just wind Greg up and let him go. So we're going to be talking about capital today. Brandon, give us a little recap though of what it's been so far through the first 3 episodes, and then kick us off on the capital discussion.
Yeah, so we try to design these so that you don't necessarily have to follow them in a sequential order, but in case you are, just to kind of bring everyone up to speed, we kind of kick things off, got everyone familiar with what was going on in the marketplace. That's kind of the first step in looking at where you're at, what's going on out there, making sure you got a game plan to address that. Shifted gears a little bit and talked about removing distortions in your data so you have clarity of really where you're at. Without that, you're driving down the highway with a blindfold on. The last one that we went through was around 2 numbers that you need to look at in order to get profitable with what you have. And we discussed gross margin thinking and labor efficiency as those 2 keys. And so if you haven't listened to those, feel free, go back, take a listen to them. Some really good content in there. As Mike said today, if you kind of follow the whole pattern here, if you're able to get profitable, you're going to start to generate some cash. Or if you are profitable and you've made a few of those tweaks, you're generating more capital, hopefully, than you were in the past. And so we're going to kind of talk about that today. What is it we need to make sure that we're tracking and looking at? Why is it important, and what have you there? So, Greg, I guess kind of kick us off here as we look at capital. There's basically 4 things that we talk about with our clients. And so just kind of give us a brief overview of what we see as being the most important there.
Yeah, and unfortunately, when we talk about capital, it involves you actually looking at this thing called a balance sheet, which is that financial report that entrepreneurs tend to not look at, and even if they look at it, they go, "I don't know what this means." And so I've looked at it over years of saying, okay, how can I really approach this and simplify it? And really, what we've been able to do is Simple Numbers takes the balance sheet and actually gets it down to 3 numbers. And you think about it, every privately held business, because you're not under SEC rules or those kind of things, entrepreneurs have this tendency, and a lot of you listening to this have done this, is you use your business to buy things that aren't relevant and spend money that's not relevant to the operation of the business. You loan money to another related party. You take a shareholder loan that you not really ready to call a distribution. Oh, I think I might pay it back. No, you're not going to pay it back. It's really a distribution. And so essentially your balance sheet has trash on it. And when we do our monthly models for clients and do planning sessions for the initial session with a client, we look at the balance sheet across time. And in the way that when you start laying out a balance sheet and watching it move across month to month to month, you start to realize that there are certain accounts that don't change. And usually that's your first clue that that's a dead body on your balance sheet, as we like to say. And so you've got to address those and clean it up. And so, but still, the balance sheet hasn't evolved in its thinking since the 1400s when Pacioli invented accounting. So we looked at it and said, listen, all right, let's get it down to 3 numbers. The first most important number that we look at is what we call trade capital. So there's a classic term in accounting called working capital, which is current assets minus current liabilities. Well, I'll give you a year's worth of accounting class here in 30 seconds. A current asset is something that is expected to convert to cash within 12 months, and a current liability is something that you expect to pay in cash within the next 12 months. That's it.
No charge for that.
No charge for that. You now pass first year accounting 101. And so the net of those 2 is what is classically called working capital. Well, the problem is I contend it is an error in thinking because it includes 2 numbers that we should exclude for a different reason. It includes cash and it includes debt. Any debt that is expected to be paid within the next 12 months is included in that number, and cash. And the reason why I want to exclude those and look at them separately is cash is a choice and debt is a choice. But if you carry accounts receivable, if you have work in progress, if you have inventory, if you have some prepaid expenses, if you have accounts payable from vendors, if you have accrued expenses, those are forces of the marketplace. I can influence them, but most of the time I can't eliminate them. Now, we've all done the exercise of trying to get our accounts receivable paid faster. We've done the exercise to try to use less inventory. But I look at those, and as you work on those things, you have a tendency to look at it like weeding the garden. I mean, you'll make an attempt and it'll get better for a moment, but it's like the weeds. If you don't keep hoeing the garden, the weeds come back. And so I kept looking for ways to get people to think about it. And really what I found was if I take the assets that are part of trade capital and the liabilities that are part of trade capital and net them into one number, and I look at trade capital as a percentage of revenue, it was an aha moment. And it was one of those things that if I'm if I've got $1 million of revenue and my trade capital is at 100,000, so that means my trade capital percentage is 10%. What that now tells me is the next $100,000 of new revenue that I get, I've got to actually invest $10,000. 10% of that number has to come out of my money in cash before I start to get paid. Now, one of the things that I get paid from is profit. So if I have 10% profit, 10% trade capital, I have a growth engine that's actually cash flow neutral. And so looking at this ratio, we call it the CPR, cash power ratio, of trade capital percent of revenue on a trailing 12 basis versus profit on a trailing 12. If I can get those two things equal to or trade capital below profit percentage, I am poised for growth, unlike my other people in the market or other industries, because I don't have to go to the bank to borrow money to grow. I generate positive cash flow with every new cycle. Now, not every business and not every industry has the ability, to do that. Certain trade concepts and industries, just don't allow you to do it. But we've seen people, once they understood it, they've taken an industry that was traditionally I gotta spend my money before I get paid type industry to where they either shortened it or they actually flipped it on a dime. We actually had a client in the staffing industry that figured out a way to collect up front from his clients. And so staffing is well known for being a heavy trade capital intensive business, and yet he found a way to where he was cash flow positive on every staffing job that he did. And so those are critical things, that you need to know. And so what I look for is how can I present a number that gets you to act in your best interest? And what I found is as we start to show people their trade capital percentage drifting as a higher percentage, they actually start to take action to get it back down. And they have 4 or 5 plays that they can run to do it. I can attack AR, I can attack inventory, I can attack accounts, I can get better terms and longer terms from my vendors. All of those things work and all those things matter. But also, I can, if I've done everything I can on trade capital, my other alternative is I can be more profitable. If I get profit up, that mitigates it as well. And so once people saw the relationship of those two things, we've just seen marvelous reactions, to that capital number. So before we jump into the others, I'll let you guys, share your experiences on those as well.
Yeah, I would say that you usually get people's attention when you tell them it's the one number that will predict if they could go bankrupt while they grow. People tend to
Yeah,
listen when you use
excellent.
that word bankrupt there, and you've all heard the stories like, "Man, we were doing great, everything's going well. We started to grow, and we ran out of cash." Like, what? How you're growing though, right? Well, if you carry both AR and inventory, there is a very great chance that you're going to need additional capital during a time of growth because those are the most capital intensive businesses that we come across. There's some folks that are on the other side of the equation, and these are the ones that we really like. You'll hear us get excited when we're talking about these types of businesses where we look at it and they have a negative trade capital, meaning they get paid to do the work, before they do the work. And Greg kind of alluded to that a moment ago. But if you're able to get a customer deposit put in place before you start on the job, if you're able to bill in advance, some clients bill at the end of the month for the next month's service. Those kind of, and by the way, most of them have it paid automatically so that they receive the cash, and they get some terms from their vendors on things. Then you can grow to infinity whenever you have that negative trade capital without having to put cash in, provided that you're profitable. Disclaimer there, you do have to have the profit component, but those are really cool businesses. And in a minute, we're going to talk about this return on invested capital concept, and those typically have the highest ones too.
Well, I get the opportunity to speak to a bunch of entrepreneurs, and I teach some classes for the Entrepreneurs Organization, for their accelerator program. And a lot of these will go around, and people will kind of share, what's your biggest challenge? I always love that question, and everybody's going around there, and invariably, 3 or 4 people in every group will say, well, I got cash, I got some cash flow challenges. No, you don't have cash flow challenges. You got profitability challenges. Your cash flow works exactly to the terms of the market. I mean, that is not your issue. You are not focused on profit. And I don't call them out in front of the class. I'll usually go up to them afterwards at a break and says, okay, I heard what you said. All right, let's talk about this, because it's really, you got to fix your profit. You're getting the right terms.
And in addition to that, one thing I like showing my clients too, and really trying to impact them is understanding how to leverage that AR and AP in the process, understand the importance of upfront billing, getting the cash in quicker as you do that. And I think trade capital really helps with that piece to get, Greg, one of our favorite groups that we work with, MSPs. That's one of the great things about that business, the recurring revenue model, getting those dollars in the beginning every month. And on the trade capital side, that really highlights that fact and allows and shows entrepreneurs that, hey, if you focus on those things of getting that money in or up some sort of upfront billing, watch trade capital just change, and then the cash just begins to build up.
Yeah, and I always remind people, says if you don't ask, you don't get. I mean, if you don't ask for money up front, if you don't ask, and they'll initially tell you no, just don't just take their first answer is the final. We see it all the time. Of small businesses get non-standard terms from bigger customers because if you win them over, you can keep negotiating, and sometimes you might have to take their standard terms on the first run with them, but once you prove yourselves and prove that you're really the best resource, you got some leverage to get better terms going forward. Right. So let's talk about
the next one.
Yeah. So trade capital, like I said, it's accounts receivable, work in progress, inventory, current assets, which would be typically prepaid expenses, minus AP, accrued expenses, the net of those, and deferred revenue. And if you have those, so those are the most common ones that you net that number and always track it month to month and see the movement. And our data, simple numbers data, is all about looking how things move across time, and you're comparing that as percentage to rolling 12 revenue. So the second one, the simple one to knock out, is infrastructure capital. So think of it's your net book value of fixed assets, the cost minus accumulated depreciation on the book basis, not tax. So this is a difficult one. Now, the grand number of businesses in the U.S. marketplace that are service businesses that are not equipment intensive, you're really not going to have much in the way of infrastructure, capital anyway. You're expensing everything as an expense as you do it, so you're not a big issue. But our HVAC, clients, electricians, construction companies that do actually self-perform, and they have a construction equipment, manufacturing clients who have lines of business and facilities that are relative to their manufacturing process that they own inside the business that they don't lease out. Those are big capital assets, but tax depreciation distorts economic reality. You got to have 2 sets of books, and any accountant worth their salt can allow you to keep book depreciation in your books and make adjustments for tax depreciation when you file your tax return. And this goes back to one of our previous podcast discussions about clearing distortions. Don't let tax adjustments distort your vision of the true economics of your business. And that's just one common thing that, a lot of people that have, I always ask the question, are you working for your accountant or is your accountant working for you? And your accountant that is shoving tax adjustments into your books for their ease of working with it, you're losing the ability for the interpretive value of your data. And so just don't push back and say, listen, my data is how I run my business. Your job is to make adjustments to that offline when you file a tax return. And if you can't handle that, I got the wrong accountant. So I don't give in on that. So the first part is the net book value with book depreciation over the true economic useful life of that asset, minus debt on the liability side that is associated with that fixed asset. Here's the thing. What that does is give you the ability to look at, if I finance operating equipment over its true useful life, essentially the net infrastructure asset's zero. And what it does, the accountants go around the world that I always use this example, so entrepreneur goes and buys a new truck and, comes back in and first payment shows up and the bookkeeper says, "Hey, Fred, what's this?" And says, "Oh, at least I bought a new truck." And says, "Where's the paperwork?" And he hands him the paperwork, and it was a $75,000 truck, 100% financing over a 6-year note. Well, the accountant is going to book the asset for the truck, start depreciating it monthly across the life of that truck, and then they're going to take the monthly payment and split it between principal and interest and book the note and all that transaction. And every month you're going to make an entry between depreciation to book it for the truck, and then you're going to take when you make the payment for the note, you're going to split it between principal and interest. You know what? If you actually just expense the note payment as an expense, and then whatever the gain or loss is on the truck when you get rid of it, you settle up on that number, you get to the exact same number across time. And I get it that there's a reason why the accountants and the financial people want to know how much debt there is and all those things. But from an operational understanding of the business, when I want to look at deployment of a capital asset, much in the way that real estate entrepreneurs look at cash on cash return, and that if I need to go add a work production truck, I need to know I'm adding $1,000 a month note payment for a work truck. Well, what is the gross margin that I got to go get? Because there's a check for $1,000 that is in all reality an expense. It just lives with some of it's in interest and some of it's in depreciation, but it's roughly the same number. It's just buried with other stuff. But economically, I got to think of it differently. So we look at infrastructure capital as the net of the two. And I'm okay. I'm fine with financing, production equipment over its useful life. But keep in mind, if I'm going to burn a truck out in 2 years, don't finance it for 6. Finance it for 2. They'll do that. It's perfectly fine. But that gets the cash flow relative to the utilization of that asset. And so when I can do that, I'm okay with it. But just don't make it so that you're buying something that you really didn't need. And that's kind of the other side of it. So the third piece is then the final, is we call buffer capital, and it really is cash minus line of credit debt. And so one of the things that is, for years, I'd seen entrepreneurs just get so sloppy with lines of credit. It became the excuse valve that every time that you didn't hit your target, every time you didn't do what you should have done, every time that you wanted to take money out of the business but it didn't have it, you just really drew on the line of credit, to do it. And I'm really been amazed that as we've taught our clients how to effectively use cash and protect it, taking cash and netting it to line of credit so that they see it as a one singular number of, am I capitalized? And then I would say that it comes into kind of our probably one of our best metrics is, what does a fully capitalized business look like? Well, it's one metric. do you have 2 months of operating expenses in cash, everything that you don't get terms on, all labor and all of your operating expenses? You exclude cost of goods sold because you generally get terms on those. But if you have 2 months of operating expenses in cash and zero drawn on a line of credit, you're fully capitalized. If you have more than that, you have excess cash. If you have less than that, you're not fully capitalized. It's as simple as that. And that singular entrepreneurs want certainty, and because we don't waver from that calculation, it has been one of the most amazing metrics that we've been able to show clients over the years of that is that moment. And now it is amazing, whereas I used to couldn't get people to leave cash in the business, now I got to fight them for leaving too much in it. Of our 100 company model that we use for our quarterly economic update, 80 of those 100 businesses don't have anything drawn on a line of credit. That is not standard in the marketplace. But those businesses are fully capitalized, they follow the cash rules, and they don't make distributions unless they have excess cash above being fully capitalized. And that is just an incredibly strong discipline that makes you the business that can get through the ups and downs of a disruptive market.
Yeah, excellent. And one thing to add on that, one thing I love about Core Capital is just the ability that those clients that are fully capitalized and then have the cash over and above is then being able to go be active with it and take advantages of things other people can't do. And take COVID, for example, our clients that were fully capitalized that went into COVID and got doubled up with PPP, they were able to go do some things others weren't. And it was a real cool thing to see that.
Yeah.
Yeah, I like what Greg was saying about, folks trying to leave too much in the business now. I think some of that's the PTSD from coming through COVID and what have you, because leading up to that, it was like every call people were just fighting with us about, I don't need to leave that in the business. That's too much money. I need to put it to work in other places, and, so forth and so on. And, sometimes the math doesn't always consider the benefit of having the security of knowing that things are going to be okay if something should happen. You can sleep well at night. And then, COVID hits, and within the weeks following that, you kind of get the emails and calls, and people say, "Hey, thanks for being a little bit of a jerk about that, making sure I kept that money because we need it right now." So, sooner or later, the market is going to throw you a curveball, and you need to have that. And to Mike's point, it's not just about playing defense with. You can play some really cool offense when you have some cash. You can try different things. And, one of the favorite things that I've seen with some of our clients right now, as lines of credit are getting more expensive to have into services, they're going to some of their vendors and saying, "Hey, if I pay for this in advance, what kind of discount can you give me? What kind of deal can you give me?" And they're getting some really good cash on cash return, because everybody else they're delaying payment because they don't want to pull on their line of credit to make the payment to the vendor. So you can do a lot of cool things with it.
And that's something we saw in our quarterly update. Is we didn't talk much about it on that one, but on the balance sheet aspect of those companies, irrespective of profitability, we are seeing more people hold each other's money longer. So AR days are up, inventories are up, accounts payable is up, and so you're seeing a lot of liquidity challenges, in the marketplace of the bigs. But our clients who see that and act on it, they're going to fare better than the people who just take it. Yep. And you got to be active in managing it day in, day out.
Cool. Well, we've got one other. Don't know that we've got time today to go through all of that on return on invested capital. So let's kind of put a peg in the ground here. We'll pick up on our next podcast and discuss that one, because that's one you can really use to make some cool decisions within your business.
But just to reinforce, the way you get to to actually begin to calculate invested capital, you actually have to identify what is your trade capital, what is your infrastructure capital, and what is your buffer capital. And I've got to know, but those three numbers make up the active balance sheet. Now, what those three numbers don't include are the trash accounts that the due from assets or liabilities that are on it that you've done with related parties. We're just filtering those out. The assets that you bought that have nothing to do with the business. If you've bought businesses and you have goodwill, guess what? Goodwill is a fake asset. It's a plug, so it's not, doesn't have tangible value. So it gets excluded. And so what you're doing is to go through our capital process, you are cleansing the balance sheet and getting it down to the active assets and liabilities and the true capital that it takes to run it. And it gives you a much cleaner picture. And I really recommend, don't keep that trash on your balance sheet anyway. Find a way to get rid of it, move it on, if you can. I mean, otherwise you just have to do this calculation separately, just so that you're watching that. That's really the critical things. But, we've got some big clients that do a lot of intercompany stuff. And what's really been helpful, if you're a $100 million business, we actually strip all that out and show a clean return on invested capital for those operating units, irrespective of the money that's being sent back and forth to the holding company or the management company. What did I buy this unit for, and rolled it up? And so it actually has helped those companies that are larger, but they need a cleaner picture of, am I operating to an appropriate return standard? It's given them a lot of clarity as well.
Awesome. So a little bit of a teaser there. Next one, return on invested capital. You're going to need to listen to that. It is one to where, like I said, it becomes a view that you use to make a lot of different decisions inside of your business. So we put the foundation blocks in today, and be sure that you listen to the next one so that you can get that last piece.
Great. Well, episode 4 is a wrap. Appreciate you joining us. We will look forward to return on invested capital in episode 5. Take care. Have a good one.
If you want to know more about driving sustainable profitability for your business, or are interested in learning more about CRI Simple Numbers, please visit our website at simplenumberscri.com. Thanks for listening to this episode of Profitability Playbook, the Simple Numbers Podcast. You can subscribe to Profitability Playbook on Apple Podcasts, Spotify, or wherever you prefer to listen to podcasts. If you liked what you heard today, please leave us a review. The views expressed on Profitability Playbook, the Simple Numbers Podcast, are those of the presenter and moderator and do not necessarily reflect the views of CRI Simple Numbers or the CRI family of companies. This podcast is intended for informational and educational purposes only and is not intended to replace professional advice received directly. Consult with your CRI Simple Numbers advisor or another trusted professional if you have questions about your specific situation.